Welcome to Money Talks, a weekly feature on FM 93.5 The Berg and WMEG AM 740. Today we will talk just a little bit about money, maybe some of the things you can do with it, how it can impact your life, some ideas on financial planning and investing, and getting the most out of the money you hope to have, already have, or want to pass down. So sit back, relax, listen, and maybe take some notes, as you may have some questions by the time we're done with this edition of Money Talks. Hello, Dan Joss. How are you today?
Hey, I'm doing well. Good morning.
Good morning to you. So, there's a lot going on in the world these days, and what's on everybody's mind, I think, is COVID-19, coronavirus. So let's touch base and see how this is perhaps the repeat of something else in history in a different way, and how it's affecting the markets and such.
Well, certainly unprecedented in terms of speed of market decline. You're right in that we have seen something like this before. We saw 40% decline in the market in 2000, 2001, and 2, and again in a little bit shorter period, 2007, 8, and the first quarter of 2009. Both of those were about 40% declines. And so there's really three responses I kind of walk through with my clients when they see the equity portion of their portfolio decline.
I would imagine you've had a few phone calls in the last week or two.
Yeah, I've had a couple, but I think I've done a good enough job on the front end that my phone is not ringing off the hook.
That's great. I'm glad to hear that.
And so the conversation typically goes like this, and I'll use some round numbers to make it easy for both of us.
Okay.
We have $1 million portfolio and a 60% equity and 40% bonds, or sometimes we'll say fixed income. So when the market declines 40%, we're typically talking about the equity market and not the way I invest in bonds, which are high quality and short and intermediate bonds. Those typically don't lose value in markets like these. But if we have $1 million portfolio and 60% of that is in stock, and that stock loses 40% of its value, we now have $360,000 in stocks, and the 40% of the $1 million portfolio we had in bonds, we'll just say is still at 40%, so we have $400,000 still in bonds.
Okay.
But we have a portfolio now that's 24% smaller because the 40% market decline only touched the portion of the portfolio. So now we have a smaller portfolio, $760,000, and we have a more conservative portfolio because that $400,000 bond allocation used to be 40% of $1 million portfolio, is now 53% of a smaller $760,000 portfolio.
Okay, I'm following you.
Okay, so the first response or an option is sell everything and get out of the equity market. And that's a response or a possible solution to the market decline that I don't recommend.
I think I follow that recommendation.
Okay.
Or not recommendation.
So another option, that's right, it's not a recommendation, but it's an option. The problem is when to get back in. And because we can...
I know the answer to that one.
We saw 5 or 10% declines. We could also see 5 or 10% increases in the market value too. And so psychologically speaking, an option, if I got out, is to get back in after I see a 10 or 20% recovery. And that would be admitting that we made that mistake of 5 or 10% recovery. And then the other option is to get out after the market falls even further, or get into the market after it falls even further, which we're not inclined to do.
I was going to say get out when the market's at the lowest or at the highest, and then buy it back at the lowest. I mean, that's what we should do, right?
That'd be a great strategy.
Yeah.
If you knew the future, then then you could make a lot of money.
Yeah. All right. So back to the man who knows what he's doing.
So that's typically not a recommendation.
Okay.
Option 2 is to stay where we're at. You know, I now have a more conservative portfolio, but I'm not going to buy more equity right now because I just saw it decline 40%, and it could decline 50% or 60%. But I like where I'm at. I'm not going to sell, but I'm not going to buy more. And so to stay where we're at is sometimes a very good thing. So we're not selling low. We're just not buying low either. And I'm good to go. If I had my 40% in bonds, then that meets my near-term needs. And typically, the 4% row, which we talked about earlier, would mean I have safe money in my bond portfolio for many years to come. And so I'll easily see a 3 or 4 year recovery without needing to sell my equity, and I'll allow that to grow back.
Okay.
So staying where we're at is sometimes a great recommendation.
Gotcha.
And if I add new money, if I'm a pre-retiree adding to my retirement accounts, I just add new money to equity. That gets me a little closer to rebalancing. Or if I am a retiree and I'm using my money, I'm spending from the safe money that's in the bonds, and I'm not selling my equity. So a well-designed portfolio allows for these needs.
Okay. Well, that sounds like a good thing.
Yep. And recommendation or an option number 3 would be to rebalance the portfolio. We said I could withstand some sort of decline in the market. Now we've experienced it. And so if I were to rebalance, I would be moving about 12% of the portfolio. Or to get back to 60-40, I need to move some of the bonds, in this case, $94,000 of the bonds, back into equity to get back to my original 60-40 allocation of a now much smaller portfolio. If I did that and the markets recovered over the next day or month or years, then I would have bought low that equity, and it will recover as markets always do.
Okay, that's good to know.
And I will have taken the most advantage of this opportunity in declining markets.
All right. Very good. So, Dan Joss, if anybody wants to give you a call or reach out to you on the internet, what's the best way for them to do that?
Phone number is 757-903-2127, or the website is jossfinancial.com.
All right. Well, Dan Joss, we appreciate you phoning in on your conversation with us today, and we hope you stay safe out there.
Oh, and you too. Thank you very much.
Thank you. Money Talks is a weekly program presented for the listener's benefit and entertainment. It is provided at no cost to the listener, and the ideas, opinions, and comments are not to be construed as legal advice, tax advice, investment advice, or other advice specific to the listener. Listeners are encouraged to seek the advice of a licensed professional or other qualified party when dealing with financial, legal, tax, medical, investment, insurance, taxidermy, plumbing, electrical, carpentry, real estate, chiropractic, veterinary, oral hygiene, hot air ballooning, etc. We have given you some food for thought. Now, call a licensed professional such as Dan Joss at 757-903-2127. Thanks for listening, and remember, failing to plan is planning to fail.